Bring in Bill Baruch, the president of Blue Line Futures. He's joining us this morning to talk financials. And Bill, welcome. Before we get into rates and the dollar and at these highs, the impact they're having on markets, I wanted to get your thoughts on how you're seeing some parallels as the market rebounds from the COVID crisis, similarly to, well, what we saw back in 2009 as the market rebounded from the great financial crisis.
Yeah, it's a really great discussion. It's something I've been highlighting in recent weeks in my morning notes. And the trend out of that 2009 low, very similar in how it held trend coming out of the 2020 low, really more like the November, that secondary low that took place in November 2020, September 2020, and really held a great trend. That trend began to be broken as the Fed moved closer to tightening. So a lot of that has started to take place, but it's not only there, but things within the currency space, like the Chinese Yuan losing significant value the same manner it did back in August 2015, and the Shanghai Composite blow up. I mean, so there's sort of market internals that have taken place back in 2014, 2015 as the Fed moved to their tightening, the same way we're dealing with things right now. It's a really great discussion, especially as I had really witnessed that at firsthand as my onset of trading, from 2005-6 on, and it's a really great parallel for me. Most recently, I'm looking at the VIX, and everybody's talking about, okay, we can't get an S&P bottom unless we have a VIX blowout, and I don't think that's the case. And again, I'm looking at a parallel back to August 2015 was a massive blow up. In August alone, the S&P sold off as much as 12% in 2015, and the VIX spiked above 50. But what happened is we end up trading back to a record high almost, and similar to the way we've rebounded here through March. But we then sold off in January and February of 2016. We made lower lows. January, the VIX only got to 32, and then in February it was below 30. So did a bottom happen? I think that's something what we're seeing here is more about sellers' exhaustion. And then the last component, I think, is if markets are going to bring the most pain to the most number of people. I mean, we've talked about what we've seen, the trash stocks, there's the pandemic and the momentum stocks that they're down 80, 90%. A lot of people's portfolios had a lot of the stuff it's been very hurt. There's institutions that have held some of the stuff very hurt. There's institutions that are blowing up. I mean, some concentrated positions and things like that are taking place internally. And then there's the fear. The fear coming out of here is almost similar to what we saw in the pandemic when the world was thought to be ending. So the fear's there, the blowups are there. The last is 60-40 portfolios. They're seeing the pain. The rates are rising as stocks are selling off. And then if you're hedging portfolios with a VIX strategy, during the pandemic, when COVID low came in, if you sold the low in the S&P and you had a sort of weighted VIX strategy, you actually finished positive, even if you sold the low in the S&P and got out of your VIX. Here, it's not the same case, at all, where the VIX has not gone above 30. If the S&P starts to rebound, as we're seeing here today, you're going to see a VIX smash. Say the S&P rips 10% from here, you're still going to be down 12, 15% on your stocks, but now you're going to be down 5, 10% on your hedges. So I think there's a lot going on. Again, those parallels are there, but right now I'm looking at the VIX. And yesterday, the NASDAQ volatility index, the VNX, that did hit a double top. It really from January's high of this year, similar where we've seen these lower highs in the regular VIX through this year. So a lot going on. I think is a really great discussion.
Okay, many similarities indeed. Let's talk about how, and we actually looked at the VIX at the top of the show, and I pointed out how we hadn't seen a new high in the VIX. It hadn't taken out that March high up around 3650, while the indices are in a new year low prints, and it kind of was flashing, a flag that's flying for me in terms of a little bit of a divergence that you don't expect to see. But I pointed out how we've seen the Treasuries start to rally back a significant amount. We've seen the yen rally back, which these were not safe haven type recipients or beneficiaries while the indices were selling off. And then for that matter, we've seen the dollar, which has remained at elevated levels as well, holding up multi-year highs.
Yeah, I think the currency discussion, the rate discussion is terrific. And one thing that we were looking at is 3.25 being a ceiling here. Potentially a lower ceiling brings you a inverse head and shoulders on a chart pattern from the rate side. You have a little bit of a lower high in the rates. You go back to 2014 for that left shoulder. So if we start to fail out here, it's actually pretty good tailwind down. Not to mention the futures. The 10-year futures double bottomed to that 2018 low, 117.13. We got down there. I forget the exact low here, but I think it took it out by a tick or two the other day. So it's a pretty nice bottom potential in rates. And I think that could be a really good tailwind. Now the dollar index, that's the big question here. Is the dollar index fully breaking out right now above 104? It's hard to think that we won't see that close above 104 today. Now, do we leave a tail and come in? I don't know, but it does make me nervous on the metals, where we're seeing gold and silver break some significant levels with the dollar breaking out. It really gives me a signal to step aside on the metals here. I was looking at 1850 and 2150 as being some pretty big support levels to lean into, and those have failed. So in fact, the dollar index is moving and doing what it's doing right now. Could bring some added pressure to commodities, but crude is certainly ignoring it.
Now, the dollar, I want to kind of dive a little bit deeper into this with you, Bill, for a second, because while we've seen the dollar rallying as the Fed became a bit more hawkish, I guess I'm wondering, is it kind of leading us here down this, dark path in many ways if rates continue to follow ultimately in terms of how it could impact the economy? But I guess, while rates have eased a little bit, it's pretty clear that the fundamentals that have us at these elevated levels remain. And even as recent as yesterday, we heard from Fed Jerome Powell mention at the top of the show how he said we can't really affect supply with our policies. And this is in many ways supply driven as far as what we're seeing as far as some of the inflationary pressures.
Yeah, and that's really stoking the inflation fears, is that supply side. I mean, with China remaining in lockdowns, and there's zero COVID policy. So there's a light at the end of the tunnel with Shanghai, and I don't think it's much of a coincidence that we're starting to see some positive action here in stocks. Now, we got to hold, obviously. You're seeing crude sort of have this really steady grind, and each little minor pullback is holding some really good technical support levels, very constructive. I don't think that's a coincidence either. But I think for the metals, I would have expected the metals to see a little bit better move on positive China news. However, again, that U.S. dollar, they say you get the dollar right, you get a lot of things right. And the Fed have sort of had to up their hawkishness in recent months. So that's kind of stoked the dollar. You have the war in Ukraine that's also been stoking the dollar. And then the yen, the sort of unhinged move in the Japanese yen. So all those are big components in the dollar index, mostly being the euro. I think it's 57%, and the yen is number 2. It's like 15% or so. I forget exactly, but they're all stoking the dollar index. But the Chinese yuan is also at the weakest level since 2020, I think maybe September, October 2020 against the dollar. And we don't see the Chinese yuan in the dollar index. So it's something that I'd like to keep an eye on to get a pulse on the metal specifically. So yeah, get the dollar right, you get a lot of things right. And but we'll also see rates too. Rates are going to be extremely important here. But you're seeing the 10-year back down, so you're seeing a little stability. I think above 2.8 in the 10-year yield right now. So we're watching that closely too.
Bill, a big part of that dollar rally, as you mentioned, the euro currency making up 70+% of the dollar index futures contract. And the euro has been coming off. It's been weakening with kind of a mixed message. It does seem like at some point the ECB is going to have to get a little bit more hawkish and start to address some of the inflation issues, because this is not just a U.S. driven problem. This is ultimately a global concern.
Yeah, it's a global concern, and there was some inflation data. I caught corner of my eye this morning. I think month to month in Spain was actually a contraction. I got to check that though. But we could see. I think we had the CPI data this week, and obviously the month to month move here in the U.S. was a big surprise. And I mean, you can see if you watch the Nasdaq tape, it fell 200 points in a matter of minutes. I mean, it was something that was really wild to see. But that was a 0.6 increase in CPI from month to month. Now, April was never supposed to be this inflection point where we would see peak inflation. Now, it was a matter of inflation should be cooling by now, but that was not the case. I mean, really, the major focus is going to be June, July, and August inflation. That we start to get in July. In July, August, and September. And if that doesn't cool off, then the Fed is really going to have some issues to deal with. And that's But between now and then, we may have had some capitulatory action in equity markets and risk assets, and be able to get a rebound into that summer. And that's why you're hearing Fed Chair Powell, yes, in his comments yesterday, not really too upbeat about being confident in a soft landing, but he did reiterate the 50 basis point hikes in June and July. And I think the reason why they're really going to step on that narrative and make that their rhetoric is because they have June and July, because we're going to have inflation for May and June at that point. But if inflation doesn't cool by the end of the summer, then they're going to have their back against the wall. And that's where, hopefully we can see the equity market make its way back to, somewhere between 4,300 and the S&P to 4,500 by then. That's something I think would be important. And give really everybody a chance to reevaluate as we head into the summer and use those inflation numbers to sort of foresee what the Fed's going to have to do.
Bill, as we put this week behind us, a volatile week, a wild week to say the least, what do we watch for next week as we have some housing data I saw coming our way, but kind of limited in terms of, some of the focal points that we've been so dialed in on as far as like inflation numbers and jobs and such. Here you can see in terms of, it looks like the NAHB, I saw, retail sales definitely will be a factor, but I guess the question here being, what do you have your eye on in terms of focal points as the dust settles from some of the price activity we've been discussing?
Yeah, it's not ironic. We're in this the third week of the month usually is sort of an open area for data. Like you mentioned, retail sales. And no one really expects retail sales must be this blowout number. So I think it's important to keep an eye on the consumer there. But I think overall, it's one of those. It could be no news, good news sort of week. If we can close positive here in equity markets, get a little bit of momentum. We're going to have a heck of a battle. And so really, it's going to be more about the technicals next week. And technically, I'm looking at if we can get a nice steady rebound here. A little ways away still, but couple percent. We're talking 40, 56 is that low in the S&P that from last week. You got 40, 65, 40, 60s were the opening bell highs in the S&P futures that we got to keep a close eye on. We really have to get out above there. If we cannot get out above there, then the sellers could really quickly take back control. Today, I don't want to see this rally fade. I don't want to see us close today below 39.30. Nonetheless, retest the lows. But we get below 39.30 area today, that could be really ugly. So I think it's going to be important, the technicals. And then from a relative strength, basis, I think watch the Qs against the consumer staples. So the XLP, so QQQ over XLP. You look at that, looking for some relative strength divergence. Sort of a strength thrust higher in NASDAQ and tech. So I think tech's been really beaten down. We've been adding tech into some of this weakness here and really starting to get a little overweight tech and in the way I'm actively managing things. So I think a good tech rip is due here. But again, it's about the technicals, and if we continue to close out above good levels, you don't want to see it close below good levels.
Okay.
Bad levels.
Possibly with rates coming off, that will help aid that some, and we will keep a close eye on those levels. Again, 40.56 to the upside, it sounds like, to the downside. Again, 39.30 today. Appreciate you joining us here, Bill. Thanks for sharing part of your Friday morning with us, Bill Baruch, the president of Blue Line Futures.